Minglawa, welcome to MITV's special talk show Perspectives. For this week, we have invited honorable guest speaker Sia Wei Jen, who is a counselor of Myanmar Press Council, chairman of E-Commerce Association of Myanmar, deputy chairman of Myanmar Digital Economy Association, UNFCCI, and also adjunct lecturer for MBF, EMBA, and MBA course at YUE. Sia Wei Jen has also worked in UK and Singapore in the professional capacity in banking and finance for more than 15 years. Minglawa Sia.
Minglawa.
Thank you for joining us for today's talk show. Today we are talking about valuation. So please let me share your knowledge in why valuation is important for business.
Wow. The value, value determines, whether the price that you pay is good or bad, right? Everything in life has a value. Even human beings has value, yes. Right? So only when you're able to value something, I don't want to value humans, but it's also a form of valuing, a form of valuation, right? Be it a property, when you're buying apartments, condos, when you're buying landed properties, or when you're buying businesses, you're buying a shop, you're buying a farm. Everything is about valuation, yes. Right? Value, you got to pay for that value, right? So that value and the actual price that you pay, whether you overpay or you get a good deal, valuation determines that, yes. Right? That's why everything you must do a sort of a valuation to know how much you have to pay for that particular piece of asset.
Yes.
Yeah. So that's why valuation is important. And the other point is, every investment, before you buy something, right? Before you buy something, be it a car or be it a house or be it an asset, investment, property, business, you need to do a valuation. You must do a valuation. Otherwise, you may end up overpaying for that thing.
Yes. And how do you value companies and the businesses?
Okay, essentially there are 4 ways of valuing companies and businesses. Obviously, all of these need some form of financial or accounting knowledge, right? The first method is we call it net assets valuation. Yeah, everybody knows the meaning of assets, right?
Yes.
Net assets mean assets minus liabilities. So the first is a net assets valuation. The next one is earnings or revenue multiples, we call it in finance. And the third one is the discounted cash flow. You discount the cash flow, and the last one is a free cash flow to equity. Yeah, so these are typically 4 valuation methods that the financial management or finance books will tell you. That we actually use as well. It's not just theory. In practical, also we use that.
Yes. And next question is, what is the first model, and could you tell me net assets valuation?
Yeah, as I said just now, net assets mean the company assets minus the company liabilities. That is a net assets. So you look at the net assets at the market value of the assets. That is how much you got to pay for the company. Obviously, every valuation method, it has its pros and cons, advantages and disadvantages. Yeah, so net assets is, the advantage is easy to understand. Everybody knows assets and liabilities. Yeah, the disadvantage is a company may have a lot of intangible assets, such as brand names, such as goodwill, right? That is not reflected in the financial statements. So all these things, net assets valuation will not take into account. So normally what we use is net assets valuation, we use the baseline. Yes. So net assets is the minimum that you're going to pay if you're going to buy a business or a company. The minimum is whatever assets that you got, you're going to pay for at least that amount. You definitely have to pay more for that. But at least you know the baseline. What's the minimum that you have to end up paying.
Okay. And the next one is how you can have earnings or revenues multiples.
Okay, this is also another very popular method of valuing businesses and companies. Right, you have the earnings. You have the earnings mean profit. Right, profit means you have the revenue, which is your sales, minus your cost, minus your expenses. That's your profit. Right, that profit So the value is how many times of that profit. Right? So if you, for example, let's say every year you make a profit of 100,000. If you are valuing company at $2 million, so it will take like profit how many years? 20 years to get back that 2 million.
Yeah.
Because every year you're making a profit of 100,000 only. Right? So it will only, so that means, well, that's in financial term we call it 20 times multiple. 20 times the earnings.
Yes.
Yeah, so 20 times. So the longer it is, the more risky it becomes, because you got to wait long to get back your investment. That is an earnings multiple. So some companies, like some internet entities and some e-commerce entity, they don't have the earnings, so they may use a revenue multiples. Yeah, revenue means you look at the top line, revenue means sales. So how many times revenue you are willing to pay for that company. Yeah, so that is how you use the earnings or revenue multiples valuation method.
Yes. So, what are the discount profits or cash flows?
Yeah, discounted profits or cash flow is something to do with the typical discounting. You know, discounting and compounding. Discount is, in financial management or corporate finance terms, it's not the discount that you ask from the shop. You go and buy your clothes or computer, can I get a discount? It's not that discount.
Yes.
Discount is the opposite of compounding. Compound means you accumulate the interest. For example, if you were to get $100 1 year down the road, the $100 1 year down the road, next year, the $100 in today's value, is it 100 or less than 100? It will be less than 100, right? Because if you have 98 now, you can earn some interest, and next year it will be 100, right?
Yes.
So that 98 is called the present value. The 100 is called future value, right? Future value, getting back to the present value, we call it discounting, right? Present value get to the future value is called compounding. So in a company or in a business, you determine the future cash flows. In the next year, how much you're going to get. Next 2 years, how much you get. Next 3 years, year 3, how much. Year 4, how much you're going to get. Right? Then you discount it at the present value. So that is the value of the company. So that is the discounted cash flow. If you cannot discount the cash flow, you can also discount the profits also. No problem. So it's a third valuation method.
We have learned about from your explanation about the process of valuation and the importance of valuation for business and the companies, and also discounted profits and the cash flows, and the free cash flow to
equity. Yeah, free cash flow to equity is the last valuation method.
Yes.
Every company, we have to calculate the free cash flow. The free cash flow is referring to, company operating cash flow minus the company whatever you need to invest back. So operating cash flow minus the whatever cash flow that you need to reinvest. Because sometimes the company computers get old, so many cars get old, right? So many companies' machines get old, so you have to reinvest. So that is called investing cash flow. So the company operating cash flows are like your sales, you minus your cost, that's your operating cash flow. Operating cash flow minus investing cash flow, then you got the free cash flow, right? So that free cash flow you calculate for every year, and the same thing, you discount it back, and you compare it with your equity that you got to put in. Yeah, that is your free cash flow to equity basis, which is quite similar to the item number 3, which is the discounted cash flow. Quite similar, these two are. Yeah, so essentially, you can value companies, businesses that way, even the properties.
Yes.
When you look at that, how do you value properties? Obviously, every property you have income, isn't it? Right? If you have a house, right, you can have the rental income. If you have a condo, also you can have rental income. That is your cash flow.
Yes.
So you can have the rental income for how many years? You discount it back, then you get the present value of your condo or your landed property. That's how you can value the properties. Yeah, so that is a discounting. Yeah, you determine the cash flow and you discount it back, you get the value of the property. That's why even human beings also you are valuing. Do you see that? Why your values? For example, like if you are a doctor, right? Your monthly cash flow is going to be better than your teacher. Right? Am I right? Right, doctor. So which means so that's why people say, oh, doctor is more valuable than just a teacher. Right? So that is the so we are always valuing things consciously or unconsciously. Even human beings we are trying to value.
Okay.
Yeah?
Yes, very interesting. And what is the how to evaluate what are the things to watch out for?
Okay, normally when you talk about valuation, sometimes valuation is not really a science, right? When you want to buy companies, it's not just about value only. It's about the art. It's about whether I can get along with you, whether I can work in the future together with you, whether when you're talking about property, property, whether in Chinese there's a feng shui there, property is located in a nice way or this direction, that direction, property facing the sun, facing the bad neighborhood. Yeah, so all this type of thing has to consider. So it's not just the financial value. So the investment decision typically it can fall into the art rather than the science. That's the first thing. And second thing, before you buy into business, you cannot just look at cheap things alone. You cannot buy because it's cheap, and your valuation is 5 million. The people are only asking 4 million. Then it must be a good deal. You cannot think about it that way. You got to look at the integrity of the business owners as well. Whether the people who are running the business they are honest or not. Right? Yeah. So you cannot just say, oh, property is cheap, let's buy that. Well, the people selling the property, are they honest or they're doing something illegal? Or is the property actually being owned by them? Or did they really own the property? So all the other things that you got to watch out. Yeah. Plus, when you're buying a business, you got to understand the business model as well. Right? Some business model these days, they may be quite difficult to understand, especially in the IT side, especially with these days, cryptocurrencies and all these IT knowledge or programming involves. And then you have difficult to understand. Then, regardless of how cheap it is, if you can't understand the business, you probably should not buy that business. Yeah, so that's the thing. The last point is, the person who is running the business, whether he has a love for money or he has a love for business. So we want to work with people who have a passion for business rather than just looking for dollar and cents.
Yes, thank you very much for your detailed explanation for the process of valuation for the business and the company, also the cash flow and also the discounted profits and the cash flow to equity. Thank you, Sia, for your time and your patience and your kind presence for this talk show.
Thank you.
You have been watching MITV Special Talk Show Perspective. Thanks for joining us.